Welcome to Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. And we are also 2/3 of the combination at unfilteredinvestor.com. Bobby, NVIDIA. What do you have to say?
I don't have it on live because the last time I tried to do that, I completely screwed up their earnings, but I know they're expected to be $1.75 on, I think it's 79.81 billion in revenue. So we've got that. But we've got Mr. Brightside on.
We do. By the way, I told him in the green room, I was about to tell him that I love Ryan Detrick so much because he plays a part in my life as someone who makes me happy because I am a bond guy. I see the negatives in everything. I'm also an angry guy. And when we have Ryan Detrick on, he just calmly tells us everything is going to be okay. So let's bring in Chief Market Strategist at Carson Group, Mr. Ryan Detrick. The day you come in and say, oh man, I think everything's going to hell, I swear to you, I will climb up and I'm going to jump off something very high. Today's not that day, right?
No, I don't want you to do that. So I'm never going to say that.
Okay, good. How are you, my friend?
Doing well. No, guys, thank you as always. There's lots to talk about, but yeah, I like the honor of being Mr. Brightside. I'm not a trader. I'm not a short term. I'm more of a, intermediate to longer term kind of, hey, we're going to get through this type of guy. So I'm just honored to get to come back and talk.
I want to add something. You're not just always rosy and sunny. You've been right the whole time too. The market has in fact done what you said it was going to do.
People can I throw something in, Jimmy?
Well, yeah, throw for sure.
One of the reasons I call him Mr. Brightside is because not only he's been right, because generally we are going to be okay.
Yeah.
The time that Ryan is wrong, we've got bigger problems than Ryan was wrong.
Right, exactly. Yes. But he has been right, and Tom Lee has been right, and everybody makes fun of the two of them for being, the Mr. Sunny, and everyone clicks go to people who say, oh, we're about to fall off a cliff. Which, by the way, yesterday when the 10-year was trading one at 465, in the rundown we just did, I think that there's a worry there because it's not just about inflation expectations. It's about how many of the amazing amount of bonds that need to be sold they're going to pick up. Do you think this is a big worry, little worry, no worry?
Well, a couple thoughts here. But it's a worry. We'll get into that. With us at Carson, so Carson is a large RIA, work with over 61,000 families and 600 advisors, and our team, we manage about $8 billion, right? So, as an RIA, you kind of have a glass half full to a degree, but no, we're not just blindly bullish. When we look at the portfolios we run, we're not just 100%, Mag 7. I mean, by any stretch of the imagination. I mean, I was the guy, I got made fun of. This might sound funny. I was talking about a banana peel sell-off potentially in February and March. I was all over the place saying that. Like I said, after the rally we were due for something. Early in a midterm year, you tend to get that. After a 20% year, although I know we weren't up 20% last year, but it was 2 years in a row before that, you tend to have a little weakness. And some of the technical stuff, it just felt a little stretched. And then we had the 9.1%, mild correction. And everyone kind of forgot that I was saying, well, there might be a banana peel. And then we also said it wouldn't get that bad. It wouldn't turn into a bear. And now here we are. So that's just a little color there. But boy, the bond stuff's interesting because these yields are going higher. And it's like on Friday. So on Friday, there was the first down 1% day in a long time on the S&P 500. We had 8 consecutive 1% up days without a 1% down day. That's one of the longest streaks in 10 years and one of the longest streaks in history. That's saying every listener doesn't know. After 7 weeks, we had a heck of a run. And then on Friday, everyone was like, oh, my goodness, did you see global yields? They're higher. Like they've been going higher all year. And I know Japan, the PPI came in at 2.3%, more than the 1.7 or the 0.7% expected, and that sparked it all. But one of our big themes, and I'm sure last time I was on with you guys, we talked about this, at Carson Group, we think we're in an inflationary growth environment. People hear the word inflation and immediately think the end is near. Well, we're a really smart guy named Son of Argus, who's actually in Chicago. He lives in Wrigleyville, so your neck of the woods, Sono.
Yeah.
Anyway, so Sono looks at this macro stuff. He said, hey, we're going to have a pretty good economy. We're probably going to have a good stock market because we're having 6% nominal GDP, which goes straight to profits and straight to profit margins. But we're also going to have probably 3.5% inflation. So that's inflationary growth. Those are some of the themes we've been talking about. So we're not shocked. I mean, maybe a little surprised at 10 years where it is. We're not shocked that yields are higher. Inflation's running a little bit hotter, but the market market is doing okay. These are some concepts we've been talking about for a very long time now on our team.
So let me ask you, Ryan, the yields yesterday bothered me as well. So I told Jimmy earlier, I did a little bit of Ryan Detricking on yesterday's yields.
Wow.
When the last
middle of the afternoon,
I was bored. No, I'm just saying the last time yields peaked this high, within 3 months, the 10-year dropped between 25 and 80 basis points, depending on what year you're picking. The 30-year, the key caveat of the 30-year was 2023. It literally dropped 75 basis points after it hit 511 in 90 days. Now, the caveat there on the 2023 story is that the Fed was in a hiking cycle and they quickly switched to an easing cycle, right? Or a potential easing cycle. So with inflation where it is now, we all know that stocks go up in inflationary periods because it's an asset.
Inflationary growth periods, particularly.
Right. Growth periods, yeah. But I mean, we're talking about inflationary periods too. Stocks are an asset, and people forget with inflation, you get asset inflation, right? The hitch here to me is gold with rising yields. Gold is not an inflation hedge when the Fed is fighting it. So in a growth period like this, you think the Fed tries to fight inflation with growth as sort of the safety net for it? Or what do you think about that whole picture?
Yeah, that's an interesting one because obviously, I guess it's on Friday, right? I think Warsh takes over the Fed officially on Friday, so they do the handoff. And I mean, we all see the same stuff. I mean, Warsh is out there literally in front of Congress not that long ago talking about AI as deflationary or disinflationary, whatever you call it. And I don't disagree. I don't think anybody disagrees here, but the reality is what we're seeing now. You know, maybe 5 years from now, inflation's not as hot, but where we are now, I mean, the Fed's in a really tough spot. And I know what the Fed fund futures say, the more likely of a chance of a hike before the end of this year. We're still in the camp the Fed is probably on pause. I don't think they're going to cut. I don't think there's any cuts coming. But I think the Fed's more going to be on a pause here. Again, you know, that's what he's kind of said he's going to do. Right now, I know it's a voting mechanism. I know there's different people in the chamber of the Fed, and you know, I said maybe the first Fed meeting he'll come in with like some Dunkin' Donuts or something to get everybody good side or something. You know, but the reality, I think the Fed is in a tough spot. Without saying anything, everybody doesn't probably realize. But from a fixed income point of view, one of the concepts we've been talking about for a while, we're underweight duration, we're underweight bonds. It's like, okay, well, yeah, but I mean, we've been saying that for quite a while. We say diversify your diversifiers. Like in the old days, I know it's probably anyone listening to this, but the old days, 60% stocks, 40% bonds. You set it and forget it. Your financial advisor did that every year and rebalanced. Everybody's happy. Made a lot of money. But what's happened clearly the last 5 years is bonds have not zigged when stocks zagged. Everybody knows that. That's, I mean, 2022, stock market's down 20%. First year in history, stocks were down that much, and bonds did absolutely terrible, right? I think they had their worst year since George Washington was president. And now fast forward to where we are now, and you look again at that other stuff, and what we've done in our portfolios, we have some managed futures. We have some gold. Not that gold's a little rocky lately, but gold's up 65% last year and 25% as of the end of January. So I think it's just due for a little pause there. But we have some managed futures. We have some real assets, some hard assets. We have a little bit of cash. I still think we are actually having some really spirited conversations internally. When you look at a 10-year at 460, you start to think to yourself, you know, maybe it's time for some bonds. You know, maybe not saying it officially, but maybe those are the things we're talking about. But we are still, if duration's about 6.5 years, we're probably still around about half a year underneath that in the models we run. So by no means are we big bond bulls. We've been underweight bonds the whole time. So honestly, I'm not losing too much sleep over the bond dilemma that we're in because we are underweight, and I still think stocks are going to do just fine. That's how I think of it, like a portfolio manager, I guess.
So here I have a question for you, and Bobby, this is going to be a question for you too. It's gonna take about 30 seconds to tell you this thing, and it's not just because I want to hear myself talk. So I think there's 4 different elements of inflation, 2 to 2. So on the inflationary side is obviously crude oil, which is, in my opinion, could be a transitory thing. The other is global money supply, which is increasing a pretty troubling level, along with money supply in this country too, to a lesser extent. Okay, those are 2 things causing inflation, in my opinion. The 2 things that are working against inflation are going to be, which by the way, I was on a show before and I was counting it down, and I totally went one like this, and then just totally, and then I looked at my finger like, oh, you can't flip off the camera like that. The 2 things that are disinflationary, I think, is the immigration story, is that, you know, they're not competing for jobs as much anymore because we've shut that down. And the AI disinflationary story, which is a big deal. I think in about 6 months' time, the crude oil is going to jump from one side to the other. It's going to be 3-1, and we're going to be worried about disinflation. And Kevin Warsh is going to be free to ease. First off, Ryan, what do you think of that thesis?
No, listen, I don't totally disagree. I mean, where we are now, we saw those inflation worries, but we know what the market does. I mean, you mentioned the word inflation, and Bespoke mentioned this on X the other day, but if you look at like how many searches for the word inflation were done on Google Trends last month, it's more than in 2022, which is kind of incredible for people who remember 2022, we had 9% inflation. So as market participants, our job, right, as stewards of assets, our job is to focus on what's priced in and what's not priced in. And when I see that, and when I hear from some of the people I haven't heard from in a long time, all of a sudden tell me, hey, did you see yields are going up? I start thinking to myself, boy, this is probably getting a little bit long in the tooth. So I think those are some concepts that make sense. Now, I will say this, though. When you look at inflation, Sonu was saying we had more of an inflation problem back in January before anybody was. And I know the war happened and all that stuff. But we look at like 178 core components to core PCE. That's they tell us the Fed's favorite measure of inflation. What we've been seeing like a year ago, like 40% of those core components were running above 3% year-over-year inflation. Or what's that mean? Well, it's 54% now. We always talk about market broadening out, different sectors and stocks, all advanced decline line, broad market. Well, we've been seeing inflation broaden out. So I do want to see, and we'll get the data, see that start to slow down, but we are seeing broadening out on the inflation front. And that's, again, a big reason we've been a little more dicey and worried about inflation. But again, that's why we've positioned our portfolios to be in a higher inflation world. So it hadn't really hurt us either.
Yeah, Jensen Wang, I don't know how to say his name.
Jensen. Yeah.
Jensen, perfect. Leather jacket guy.
There you go.
He was out today basically saying that what people don't understand about AI is that it's not going to replace a lot of jobs. It's going to stop the formation of new jobs to a certain degree. But because of that, it's going to increase the productivity and increase of the existing workers, and the global GDP is going to rise, therefore lifting all boats. So he seems to me to be saying, yes, Jim, it's disinflationary at a very high level if it's increasing productivity, because that's one of the most disinflationary things you can have, right? Production with the same amount of cost going into it, to me, is the definition of productivity. So it seems to me like, yeah, it's your thesis is correct. What I'd like you to do, Jim, if you don't mind, is bounce your thesis of tech being the flight to safety off Ryan, because I'd love to hear what he says about that.
I'm curious about that too. So here's my thesis on that. And this is, from several weeks ago. So it actually did make me some money. In a normal time of geopolitical stress, they used to flock to four assets: the yen, U.S. Treasuries, the dollar, and gold, right? Okay. The yen is an absolute pig now. It's lost 50% of its value in 15 years. Nobody's considering the yen safety anymore. They've eliminated themselves. They're too messed up. Treasuries, people are selling treasuries because it's the very thing that has to be sold to raise money for the war. The dollar seems fine. Gold, all these companies, all these countries that had stockpiled gold are now using it. They're using it to either support their currency or to buy crude with it. So I think the precious scarcity of things for global money to flock to all of a sudden switch the needle to big tech. Nobody's going to give a shit about oil at $105 a barrel if Meta, has these great margins and Nvidia has these great margins. You like it?
Yeah, I do like that. A couple of things here. We mentioned Jensen there. I think it was 6 months ago at their earnings. So obviously their earnings are today. So 6 months ago, he made the comment. They asked that same question. He gets asked this all the time. Jobs, AI, what's going to happen? Now, he's always going to kind of give a positive view about AI, I think, given what he does. But at the same time,
AI, right?
Yeah, he's a godfather of AI. But
I have a positive view of cheeseburgers.
The thing I heard him say today was the reporter asked him if he felt any responsibility to destroying people's lives. So that was basically the way it was phrased.
It's a leading question, isn't it? But he gave the answer that, listen, AI is not going to take your job. Someone who leverages and uses AI probably will take your job. And he said that about 6 months ago. And he's probably said it before then and after that too. But I've always thought that made a lot of sense from that point of view. Now, getting to tech in general, we've had a slight overweight to tech all year. Now, okay, it's great now, but believe me, as everybody knows on this one, in March, that didn't feel so good, and you look at what's happened though. It's just amazing. I mean, looking at here's what I say here. Okay, the last 5 quarters. Okay, we've had about 2% GDP in the U.S. That's below trend. Trend is like 2.3 to 2.5%. So we know the economy hadn't been roaring higher. 45% of that have come from AI and CapEx spending. And I know everybody cites these numbers and talks about it, but it's truly, truly amazing. And that's helped the economy go clearly. Now, we do want to see the consumer come back. We can get more into that. I think the labor market's a lot better than people give it credit for. We can get to that in a second too. But getting to this, I mean, the reality is tech never went away. Right. I mean, tech was always there. The crazy thing, you guys love this stuff too. We trade options and stuff. If everybody's thinking alike, somebody isn't thinking. And I know this sounds crazy, but it was real. In February, this was happening. People were selling technology stocks, which are the cheapest they've been in like a decade, to go buy staples that were trading at 27 times earnings. I know it sounds crazy now, but that was what we saw. I remember talking to
Bobby was calling that out at the time.
Yeah, and I remember, and I just remember on our team saying, I was like, oh my God, everybody wanted to own staples over these tech stocks that were growing fast. And then you say, if anything slows down, what happens? Well, in a slow growth world, what do investors do? They reach for growth. Well, what's growing faster than anything, as we've seen, is tech. And there's other things happening. I'm sure you guys talked about the South Korean stock market. It's like 2 stocks, but you look at the earnings that have happened and just the incredible stuff that's happened there. It's not shocking. Now, listen, as everybody knows, I mean, the NASDAQ 100, which is up 27% in 28 days. Hey, maybe it has a well-deserved pause here, but I think tech is still an area, old Dan Ives, Dan Ives still says buy it, and he's always kind of bullish too, but, there's a lot of smart people that have been right on this, and they've been saying the whole time on these weakness that not to panic and not to get out. And software, I get they've been beaten up, and, we actually did a trade on software. It didn't work all that well, but we've been overweight tech in general. We still think that's an area I think you still want to be overweight with. All just these earnings justify where these companies are, in our opinion.
But you're not, it means you should be taking some profit and adjusting your position to be comfortable with it too, right? I did sell some Micron and AMD, bought some Qs. So you agree with that too, right?
I do. Now, one other way we play, yes, short answer is yes, I agree. We've been overweight momentum, right? Like SPYM, okay, momentum, the ETF. We do trade a lot of ETFs, and maybe this I can probably talk about it because I think it's happened. Like earlier this week, I think Monday, we sold some SPYM, so momentum-based ETFs, so S&P 500, and we went into just the SPY, right? So we have trimmed some of those big gains in some of those areas. Now, listen, we run like 26 different models. Some of them are longer-term strategic, some of them are more tactical. So I guess right now I'm talking about the more tactical, shorter-term models, that it makes a lot of sense to trim some of these historic gains. That's what we've kind of done, at least on the momentum side of things, to kind of ring that cash register a little bit.
By the way, can you explain, you said something that you sold that was a momentum, and what did you sell and how is that comprised?
Yeah, well, we can look it up, but it's SPYM. That's
SPYM.
one of those.
Okay.
M is in Mary. That's one of those ETFs. Again, I probably have to say not a recommendation because I have to do that.
No. Yeah, I'm just curious.
But yeah, we've been in and out of that one, and we trimmed a little bit of that one. What we did actually before the election, right? Before the election, we actually did a pretty good sized trade in a lot of our tactical models. We did some momentum on, we call it a barbell. Everyone knows barbells in this, barbell over here. We did low vol on one side, momentum on the other. And when you look at history, if you just do 50% low vol, 50% momentum, and hold it for a year, all right, and then see how you did versus like the S&P 500, more often than not, you're going to beat. And like there have been some years where both of those even do a little bit better, because when times get stressed and volatile, well, the low vol stuff does better. And then the time, like the last 7-8 weeks, of course, momentum does better. So that barbell approach has really worked. So our barbell obviously got a little lopsided because the other one's a lot higher. So we trimmed that back a little bit recently, which I think makes a ton of sense.
SPSM, the State Street small cap 600, actually just has a really good technical pattern to get back in it right now. And that's the funny thing about it. When you look a lot of these indexes and these ETFs, technically, they've either run away and from my perspective as a trader, it's too late to buy them, or they're starting to form the kinds of bottoms that you want to buy. So a lot of the times when I know Jimmy has done this as well, when I've done TV interviews and they've asked me about something I'm not looking at, I look at the chart and then I form an explanation backwards, right? So I say, okay, this looks like it's going to go higher. All right, let me think of why it might go higher. That's now my opinion for a TV interview, right? Let me ask you about a thesis. And again, if you agree with this thesis, it's not a recommendation. If you disagree with this thesis, then I'm the idiot. I've been talking about this for a while, and Jimmy, I started doing it over the last couple of days. I'm starting to accumulate a large position in Tesla. And the reason is SpaceX. It's not directly Tesla. Okay. First of all, the particular strategy that I trade with just doesn't allow me to get into IPOs.
Hold on, let me cut you off real quick. Nvidia just jumped lower.
Lower.
No, just 0.5%. I don't know if they're out or not. Anyway, keep going,
Yeah,
please.
okay.
Yeah.
Yeah, here it is. Brief Nvidia adjusted EPS 1.87 versus the expectation of about 1.76. Let me see what the rest of it says here. Revenue 8.615 million. It was expected, I thought, at 7,981. So it seems like a beat.
Yeah.
We'll see how it trades. I don't know.
Stocks trading lower initially, which means just a little bit more than nothing to me, because we all know that it can bounce around and there's a lot of noise, market positioning stuff. So it's not moving that much. It's down 0.5%.
Well, I'll just chime in very quickly. I don't want to beat the thunder, but I've always used this media quote: death, taxes, and Nvidia beats on earnings. I mean, you can do that for the last 3 years. Those are three things. We always count on those three things. Now, again, what's the reaction? What's the guidance? But they beat on earnings. So that's how it goes. Yeah.
All right. So let me finish this question. Then, Jimmy, I'll go to some of the comments.
Sure.
Well, there's 2 or 3, but I think building this Tesla position is as much about SpaceX as it is about anything to do with Tesla. Tesla's chart formed a nice bottom. I like it. I don't love it, but I like it. But the way that I trade, I just simply can't get into IPOs. There's not enough data for me to decide where to get into them, right? So I'm building this position. Number one, I think Tesla will go up in sympathy if SpaceX blows it out of the water. Number two, I think they will eventually be one giant super company. Do you think that's nuts? Again, not a recommendation from your side at all.
That's understood. No, I don't think it's nuts that they're going to have one big super company. I think that probably seems like that might be where this is going eventually. But I will say this, like in one of our more aggressive tactical models, we have like one of those space ETFs. Now there's a lot of them all of a sudden starting to what is it, ROKT, Rocket, that one, which has done really well. I mean, that's done really, really well. And we saw, I forget which company it was, like a week or so ago, had really strong earnings, up like almost 20 or 30%. So there's a lot there, the excitement there. I mean, I'd love to ask you guys this though, that you think about worries that's out there. I mean, some of these big IPOs, I'm not saying it's like 99 because it's really not like 99, but some of these IPOs get my attention when I start to see them. Now, of course, these are big companies that are making money, unlike 1999 when a lot of those companies did make money. And one other thing that we've talked about, I know Warren Pies has talked about this, our government right now has a 6% deficit as a percent of GDP. All right. Just so people know, that's like unheard of outside of war times. This is something we talked about in January. You just don't have recessions when you have that type of scenario. You know what you have? Where you got to pay the piper because you're adding $2 trillion to a $31 trillion economy. Well, you're going to have higher interest rates. That's the kind of the piper you have to pay. Maybe you're going to have higher inflation. So those are the things that are playing out. But in 2000, like people always say, this is like 99, 2000. In 2000, we had a 2% surplus. All right. Now, this is just one statistic, but policy does matter to a lot of this stuff. And I think that's one important concept to think about. But to answer your question, I just went on a real tangent there. We have some allocation to some of these rocket companies. And, obviously SpaceX is going to be a big one that does it. It brings the excitement. We think there's still upside there. Yeah.
Can I, one thing, what you said before about the fact that we're running unbelievable deficits. Do you think that's inflation / bullish equities? That's what you were alluding to, right?
Yeah, yes, it is. I mean,
me too. So then the space companies, like you guys both, I feel like I'm on an island here because the notion of going to space seems I have no interest in going to space. Are we looking at them as like, wow, this is so cool, everybody's going to love space exploration, or just the technologies that they may bring by focusing on things? What's the allure?
I like the business model.
What do you mean?
Well, I mean, you just look at, for example, what SpaceX has been doing on the private side of things, the satellite launching. And I think if someone had to ask you, do you think there'll be more satellites in the future or less? I think more is going to be pretty much everyone's answer. So I personally think the entire internet will be satellite one day. The underwater cables will be gone, or just there collecting plankton or whatever collects underwater.
So anymore. I'll just chime in. This is real world stuff right here. Like I get to fly wherever, whatever. You get to pick the airline you want. Now, I'm kind of a free agent. Living in Cincinnati, I just do Delta, United, or American. I call it the 3 food groups. We're not like one particular one at our airport. What I'm getting at though is United has Starlink on a lot of their flights, and Delta's like Wi-Fi never works for me. I mean, it's the Starlink is unbelievable. I mean, what we just talked about there, Bobby. Like it's just like you're on this plane and your internet works better and does at your house. It's wild. And that's real. I mean, this is the real stuff. And I literally pick United now because I know the internet's better. And maybe that's good or bad. I don't know. But like all airlines kind of suck. But hey, at least their internet works, So that's something I think about. Yeah.
All right. So by the way, why doesn't American? Because I'm American. Why did they just sign one deal with United? And
I don't know. We can look into that. I don't know. I know Delta. One time I had a Delta flight. It didn't even work. And it was like, I started looking into it a little bit. And they said, yeah, Delta's upgrading their whole system, but they haven't done anything yet. But for whatever reason, United's the first one that did a deal with Starlink. And it is wonderful if you have a plane. Like, not all planes have it. Like 40% of their planes have it. If you have it, oh my, you can do anything you want up there on that airplane, 30,000 feet in the air.
That's very cool.
Luis, can you put up Dougal's comment? Jimmy, let me throw his comment up because it goes back to our AI discussion. Luis, it's Dougal's comment. He's talking about AI, and he says, isn't it more about the build out at this point? AI companies are selling $10 for $1 right now. Where are we when the build out is done?
That's Ryan. You take that one because I have an opinion on that.
Oh, geez. I don't have an opinion on that. I will say one other angle. It's a good question. Another angle on is something we've been talking about and thinking about internally, about like now and then and AI rollout and all this stuff. If you look at like what's one that just came out, PPI numbers just came out last week, and the price for like software and circuit board and all that stuff is soaring, and we get it because it's insatiable demand for all of this stuff. And then you look back at the late 90s. Well, all these prices were going lower in the late 90s. You think to yourself, what's a bubble? What's not a bubble? One thing we're kind of kicking around is a bubble is something that when the prices are actually going lower for a lot of these components, people keep buying them, then maybe that tells you demand is slowing down. You're getting closer to the end stage of bubble. Right now, we're not seeing that at all. I mean, you are seeing explosive, like annualized returns the last 3 months across the board, and a lot of this AI stuff that's going on, all the inflation. I mean, literally, if you look at like PCE, again, the Fed's favorite measure of inflation, there's a big chunk of this that's coming from AI. That's one of the reasons everybody says energy's higher and grains are breaking out and all this stuff. And AI is another reason we think we're potentially going to have a little bit higher inflation, but maybe that's another sign we're not in a bubble because demand is so strong and those prices are still going higher.
I want to touch on this bubble thing real quick, but I do want to tell you both that NVIDIA raised its dividend from a penny to 25 cents. Wow. And it also says here, record quarterly revenue and net income driven by strong data center and edge computing growth with significant shareholder returns and expanding AI partnerships. Q2 outlook projects continued robust revenue and margin performance. The stock is positive right now. From where it was earlier. It's up at about 225. It's settled at about 223. So it made a recovery from being down. To your point about the bubble, Ryan, can we be in a bubble when they can't meet the demand for their products? I mean, they literally have orders they can't fill. Can that be a bubble? And when you look at, so the sort of the earnings per share ratio, the EPS numbers on those, isn't that more about E catching up to the price as opposed to it being overvalued and the price having to drop down?
Yeah, no, don't disagree. That's kind of a concept. I think kind of a concept we just talked about a second ago with some of the higher prices because people need it. And I think that's true. And I mean, I remember the late 90s. That's when I got the bug, like in 99. I was in college and everything going up. I didn't know what I was doing. I mean, I remember cutting class to go trade some penny stock on some website in the lounge where the computers were terrible, pushing refresh all the time. But I was hooked and been doing it every day for 27 years since then. I mean, that was a pretty wild time. I know things have been a little wild lately, at least in particular some of the tech and the semiconductor stocks and memory stocks that we all know and love. But the reality is I just don't think this is a true bubble. And the other one I love to look at, and we're technicians on here, right? Just advanced decline lines. Advanced decline lines have been weak-ish over the past month or so, but let's not forget the S&P 500 advanced decline line peaked in like April of 99. So for almost like 2 full years, the stock market went higher, even though the advanced decline line was going lower, showing you there's some type of weakness. Well, we just hit new highs on the S&P 500 advanced decline line, like a month or so ago. So I'm not saying, I'd like to see another one, but the reality is I don't think it's 99 when you look at things like that.
Can we take a quick break? Commercial break. Luis, will you put the banner up? This is the part of the show I ask you guys for a favor, and thank you guys so much for the support you've given us. Please try Trader Pro 3 months for free. Do it because you're interested in it. Do it as a favor to us. Wherever you do it, please just do it. We talk to options traders who've been trading options for decades and some that have been trading for days. They all say the same thing about Trader Pro, that it is the gold standard in options trading platform. Please scan that. Give it a go. We appreciate it. Now back to the show. And I had a question that was going to be groundbreaking. Oh, Bubbles. Yeah, Bubbles.
Did you say?
I'm just kidding. Groundbreaking. Bubbles. Okay. I did have what's his name? Which Schiller won the Nobel Prize for defining a bubble? And I thought his definition was bullshit and lacking. And I told him so. And he actually agreed with me. Not that because he was talking about euphoria. Great, euphoria. But it's not, you can't fuel a bubble unless there's a certain type of leverage that is happening. It's not necessarily institutional leverage, but it's mom and pop leverage that is borrowing money, getting in leverage accounts to participate in AI. In the tech bubble, we saw that. We saw it in earnest. These funds were coming out like, yeah, we leverage you up and buy tech stocks. And then all of a sudden the music stopped. I don't see that right now. Do you guys see that? Bobby, let me start with you. Do you see a lot of people borrowing to buy AI stocks?
No. I mean, look, every trade I do with Reg T, so I'm theoretically borrowing. Yeah. But I don't ever exceed the full amount of money I have in my account. I just don't allocate that money out of my account. So, if I want to buy $10,000 worth of stock, I use 5,000, but I have 15,000 in the account. Right. So like they could actually just take it if they wanted to. So, but yeah, no, I don't see a lot of that. I don't see a lot of that at all. I think a lot of it, believe it or not, a lot of the margin calls and things like that were bought with the sell-off in gold, in my view. They were covered and then the market recovered and now people don't have the cash to buy the gold anymore. By the way, I did say this to Jim last show, Ryan. We did see the World Gold Council still showed record central bank buying. They're just buying it cheaper right now.
Yeah. So a couple things here on some of that stuff. I travel the country. I get to talk to financial advisors and specifically their clients all the time. Like all the time I get to do this stuff and I love it. And when I'm in the room and there's 100 people, I joke I've gotten really good at speaking while other people eat. It's what I do. And usually I try to stop talking by the time dessert's out and I have some desserts, how I roll when I get to speak in front of people. But the reality on this front is when you do the Q&A, right? You do the Q&A, and I'm always trying to get the gauge of how people are feeling. And these are let's call it, retirees, semi-retirees, wealthy people, done well for themselves, pretty educated, understand what's going on in the world. That's pretty much what I'm talking about right now. I never get asked the question, wow, it's really good out there. How high are these AI stocks going to go? Wow, this is a 3.5-year bull market. How much time is left? It is always, and you can imagine the dollar, crypto, debt, U.S. debt, all the debt. I mean, credit card debt, all that stuff. And I get it because that's what the media talks about. And everybody gets to hear, and you latch on to some of the negative. But those are the little clues I'm always looking for. And I think I remember coming on to you guys like a year ago when everything was really squirrely back then. But just talking about the ideas that I hadn't heard from people in 25 years, and people are reaching out to me because I know what I do, saying, oh my goodness, Trump's doing this, Trump's doing that, he's going to wreck this, wreck that. And I'm like, wow, if that person is talking that way, you think the market has it priced in, and then literally the Dow went up 10 months in a row for one of the longest monthly win streaks in history. It's like that's kind of how this stuff works. But that's I don't think the average retail person is in. Now maybe some younger people that are into it that just start trading. That's what I did in 99. I was using tons of margin in 99. I had like $15,000, but I was using all the margin I could, and then I crashed and lost it all. And then someone told me, did you know people made money on the way down? And I had no idea. It's when you're young, you got to pay the price, right? I was like, whoa, you could have made money on the way down. And I was hooked. I thought that was pretty cool. So anyway,
I have a long held thesis that I just developed 2 seconds ago. Who has the money? It's guys are your age and above, and even more so guys, my age and above. That's where all the money is. They've lived through the tech bubble and the real estate bubble, two really significant and very, very different things. I don't think you shake those scars very easily. But for the next real live bubble, like where the stock market loses 60% of its value, and again, these might be famous last words, but we have to wait till all of us die off and the money's in the hands of people who are more reckless than us. Because I think we're in the asset holding class is a little bit more cautious than they used to be. Bob, is that too optimistic?
No, I totally agree with you. I'll tell you guys a quick story. It's probably too much information, but it helps explain the story. My wife's got 2 weeks off from work. We're thinking about buying a Jeep Wrangler. So as a surprise, when she was out Monday morning, I went and rented her one, right? Just rented her a 4-door Wrangler Rubicon. She's all excited. But on the way back, I got there early because I had a short window to get it during the day. and the guy hadn't washed it yet. I'm like, don't worry about it. I got a membership at the local, spinny car wash right near my house. So I pulled in there. I'm like, you guys know me. Can I just run this car through? And the kid's like, yeah, what's the number on your account? So I tell him, and then he goes, what do you do for a living? I said, well, I'm in finance. He goes, but what do you do? I said, well, I'm a stock and commodity analyst. Do you trade for yourself? Yeah. Okay, let me show you my charts. This is an 18-year-old kid at a car wash.
Joe Kennedy story. Joe Kennedy.
Yeah. And he's literally going, he goes, yeah, I just think I should buy every dip. Usually I use the fibs because, nothing's better than the fibs. And I'm actually like, well, GAN is better than the fibs. Wait, what? Let me write this down. And I thought two things to myself. These kids this age are going to be way richer than us, or they're going to break the whole thing. And I like to, because I'm talking to Ryan Detrick, I want to lead to the richer one, So what are you guys' thoughts on that?
Well, yeah, they're going to learn the hard way. I mean, it wasn't that long ago in 2021 when, everything's going up. Everybody got money from the government. Those SPACs are going crazy, and people had TikToks, and they're talking about all this stuff. They don't know what they're doing. And then, of course, 22 happened. Everybody blew up with all the stuff, all the leverage and everything that happened. But, those scars are important. I mean, we've all been there. We've all done it. We've all sold at the worst time or bought at the worst time. And it's, I think it's very valuable to go through that because you can talk about it all you want, but until your portfolio does something like that. I mean, one of the stories I've used. So I started working, I graduated 2001, started working late 2001. My first 10 years of investing in my 401k, I literally was down because in August of 2011, the U.S. debt downgrade, the S&P fell 19% in 4 days. I remember looking. I said, I've been throwing money at this thing for 10 years. And literally what I put in, I don't know what the number was, but I had less money than I put in. I don't care who you are. You can say long-term, you make money. That's a sickening feeling when you realize that that's what's happened the last 10 years. Yeah. But that, now we're on the other side of it and we've had this cycle and maybe a little glass half full type of thing. And this is something a lot of people like to talk about. To me, we're in a secular bull market. I think most people probably agree there. A lot of people argue 2009 was the start. I would argue 2013 because we had a peak in 2000, peak in 2009, and peak in 2013. So you broke out. And you go look at these secular bull markets. We've had a couple of them throughout history, and this one's 13 years old, but that'd be by far the shortest. I mean, these secular bulls can last a while. Doesn't mean every year is going to be up. Doesn't mean every year is going to go straight up like that. But I think the bigger picture point of view is this is still a bull market. But one more on this. This one's 3.5 years old. Now we're going to get a little more granular with the cyclical bull market. It's 3.5 years old. Started October of 22. And you look the last 50 years, guys, we've had 5 other bull markets that made it to this point. The shortest any of them went was 5 years. The average was 8 years. Now, I'm not saying this one's going to go 8, but I am saying bull markets like a cruise ship. Once they get moving, they're hard to slow down, they're hard to turn around, and they're hard to stop. Once a bull gets to its third birthday, it's kind of that magic number. We've had a couple bulls, like the one off of COVID. It didn't quite make it that far. It was up like 100%, and then kind of rolled over, and 2022 happened. But once you get to that third birthday, that's that magic point where, well, magic might be the wrong word to use. That's an important point that the cycle keeps going, and this can change in a heartbeat with some tweet or something. I understand, but that's just stuff that we've been talking about, and I still think makes a lot of sense for investors. Yeah, tech's a little up here. Maybe financials, which have been terrible, by the way, and everybody knows that. Maybe financials take the baton back because I think cyclicals are still the area you want to be. Your industrial, financials, technology, those things are still the economy that does a little bit better. And we're going to have 6% nominal GDP growth this year, probably. That's pretty darn good. Yeah, a chunk of that's inflation, but does Wall Street care? The answer is no. 6% nominal GDP growth goes straight to profits and straight to profit margin. So yeah, that's why the stock market's at 1% an all-time high at the time we're doing this, because those earnings are so strong. And yeah, inflation's hotter than probably anybody wants. And yeah, we all want the Fed to cut and this and that. But hey, it is what it is. We have the market we have in front of us, and it's still one that's led by a pretty good economy, in my opinion.
You hit on something because you just said, cyclicals, which I love that. So because earlier this year, I wanted the rally to broaden out, and it was broadening out nicely. The Russell was outperforming and things like that. I'd like to see more market breadth improve too, because you said it's gone lower and we can still go higher or go lower. I just feel better when it goes higher. Mm-hmm. We did a whole show on it last week with Vincent Randazzo, who's very good at market breadth. So you mentioned cyclicals. In my mind, energy. Energy, we're talking about AI. We're talking about a crap ton of energy. And copper still looks good to me. Silver still looks good. Nuclear looks good. Lithium looks good. Are you guys putting allocations to that? And if so, any names you can share? Any interesting things?
Well, yeah, I mean, short answer is yes. I mean, we have definitely added to those areas, specifically energy. Now, I will say, On a commodity front, we've actually had a decent amount of managed futures, actually. And those are kind of boring because they really haven't worked for years. Honestly, managed futures haven't worked very well, but they have this year, So again, managed futures again are kind of trend following mechanisms on commodities, different things. And those have done really well this year that have really helped, like specifically back when the market was down a lot and everybody's getting worried and bonds hadn't done well. Gold managed futures have done pretty well. So that's one area that we're looking at it now. We have some XLE. I mean, we're talking about maybe adding a little bit more. I mean, I know oil is down today because there's rumors of this, rumors of that. We'll see. I mean, one of our bigger themes, or my bigger themes, is coming into this year. Energy was probably going to have a pretty good year because I thought energy was going to play catch up with a lot of the like gold and silver and all the other commodities, platinum, palladium. They all broke out last year. They all broke out. Well, you could argue gold broke out 2 years ago. Anyway, but energy and crude oil hadn't yet. So like to think that crude oil is up over $100, I know why. We all know why because the Strait of Hormuz and all that stuff. But then you could say to yourself, this was probably going to happen anyway because commodity prices tend to follow each other, and it's kind of follow the leader type of deal. So those are some areas I still think make sense. You guys might know this. What's energy? 3 or 4% of the S&P 500, right? I mean, so we're slightly overweight that, not by a ton, but then you factor in the managed futures that we have, which again has an energy component to it and a trend following component to commodities to it. And I think then you could say we're probably overweight that area. I've said for a while, if you drop it and hit your foot and it hurts, that might be something you own in your portfolio a little bit more than bonds. I mean, we have bonds. Trust me.
I like that.
Yeah, we have treasuries. Like we have to have that stuff. We manage money. We have to have that stuff, but we're underweight that stuff, right? We have this other stuff. Diversify your diversifiers is a phrase we've used at Carson for 18 months now, meaning the other bucket, your bond stuff, have a diversification there. And thank goodness, because literally the time we're doing is bonds are down on the year. S&P's up, 8% or something? Oh, one more fun one. This is more getting into my market strategist guy, but we're up like 8 or 9% for the year right now, something like that. But bottom line, only 4 times in history has the S&P 500 finished the year between up 8 and 10%. That's like your average year. Average year is about 8 to 10%. Only 4 times in history has that ever happened. What does that tell us? Bigger moves are more likely. When you're up, you're up 19% average. When you're down 14% average. Look at this the last couple of years, right? 2020, we gained 16%. 21, we gained almost like 30%, 25%. And then 22, you lose 20%. And then 25% back to back. And then last year, like another 16. I don't hear me saying too many, 8% gains in there. It's important to kind of remember these things, that these broader moves are more likely. And it's not crazy to be up 20% in the history of the market. Well, since 1950, we've had 23 years gain at least 20%. 22 years were down. The odds of an up 20% year are more than a down year if you go back to 1950. That's kind of wild when you think about it. But again, those concepts as a more of a kind of investor and a little longer term thinker, those are things we really try to stress. And it's really important to remember.
I loved every bit of that. And I had questions, and it was so good. You made me forget all my questions that I was going to ask. Bobby, what do you got?
So Jimmy mentioned we had Vincent Randazzo on last week, and he's a portfolio manager of the SPDF ETF. Okay, now it's new. And essentially, he uses a mixture of market breadth and some other things to essentially pull people out of the market when there's a high probability of a longer term bear. And then they get back in when things shift. Now, he believes that his ETF is going to outperform the indexes. In your experience at Carson and everywhere else, have you ever seen this kind of a thing work? I mean, this is a very new ETF. And
it's based on market breadth. I don't know, Bobby, you didn't say that, right?
Yeah,
it's totally based on breadth. You did say that.
It's not totally based on market breadth, Jim. It's mostly based on market breadth. And then there's some other indicators in there. Have you ever seen anything like this work? And again, I'm not trying to have you endorse his particular ETF or knock it. I'm just curious.
Well, I mean, I guess, I'm not going to touch that because I don't even know the ETF, but I will say I've definitely in my career seen breath work, so you've got somebody that's pretty smart. I mean, some of our friends in this industry, like market technicians, are some of the best people that I tend to follow. I mean, I have a CMT behind my name, Chartered Market Technician, not to be confused with country music television. But also, I don't have a CFA. I can play that game. I go on CNBC and I talk the game. But end of the day, I think supply and demand, relative strength, seasonality, sentiment, those, so buyers, supply and demand, those are the things that matter to move markets, in my opinion. I mean, I've done this for a while now, and that's what I believe that. So when you look at breadth and things, I think it totally makes a lot of sense to use that. I mean, I'll never forget late 2021, right? What was happening? Well, everybody made a lot of money. People are going crazy. Their TikToks, people that didn't know what the heck they were doing, telling you how to make all this money, and they made millions of dollars, and everybody lost it all soon enough. But what was leading in the fourth quarter in 2021? People kind of forget this. Staples and utilities. Like a lot of the high flyers stopped going up. The low vol, back to that earlier conversation about low vol versus momentum and kind of a barbell approach that we've taken, which has worked really well. The low vol stuff started to lead the fourth quarter of 2021. I was at a place called LPL Financial at the time. A friend of mine, Scott Brown, who's a real smart technician. I follow him every day. Scott was in his little corner saying, hey, something's wrong. Everybody was drinking from the Kool-Aid, eating from the same buffet. What's the old Barry Ritholtz thing about the great financial crisis? Everybody ate from the same buffet, and it was like it poisoned everybody all at the same time. Everybody was poisoned by how easy the money was. And Scott's over here saying, wow, look at this. There's not great market breadth, but the wrong stuff is leading right now. Nobody knew we're going to have a 25% bear market in 10 months. I mean, but then the market peaked on January 2nd, and it didn't bottom until October 12th that year. So to see that leadership from the wrong areas are things I also like to follow. That's not pure breadth, but those are things I look at. And lately, right now, we've seen Staples starting to kind of break out a little bit on a relative basis. I'm not saying it's into world stuff. After the rally we've had, honestly, I wouldn't mind growth coming back a little bit, momentum coming back a little bit, and then taking that baton later this year. But those are some concepts there. I don't know if I answered your question, but those are some things I was thinking of there.
No, that's an excellent answer. So, okay, the concept of rebalancing. Now, you believe in this concept, right? Is there a time of year where you rebalance your funds, you rebalance people, they take some off the table? So then when you have 3 great years in a row and then the big one comes, then you rebalance and buy back. Do you do that on a regular basis?
Yeah, we do. And we actually use, probably can't mention which ones, but we do use some ETFs that actually do it like every month. I mean, there's some ETFs that, have some crypto, have some bonds, have some this and that. They actually kind of rebalance every month. So you don't, in essence, you don't have to. It's kind of a lazy man's way to do it. But yeah, we do that. And again, we have different portfolios and different investment objectives and all of that stuff. But I think, with us, at least every 6 months or so, if you've got some stuff moving and it's moved a lot, it makes sense to do that. Because again, we are our own worst enemies, even us on this show that have done this for a while, maybe seen 1 or 2 cycles. We get a little worked up sometimes in certain situations, and it's really nice. That's why I think that what you guys do with this show, and you guys work so close together, to have that community, to have bounce it around. Like, that's what I would spin it as. This is why you need a financial advisor, to protect yourself from yourself. Because how many people wanted to buy everything at the peak? I mean, the apes in 2021, the memes, the ape, whatever that was, whatever. I mean, people literally at Christmas time were talking about that in 2021, how they're buying these apes, and I'm like, this isn't going to go well.
No, it's not.
And then look where we are with it. It is what it is. But those are some, I think, why having a community working together can really help you, because then they can say, listen, what's the other saying? Plans are useless, but planning is everything. President Eisenhower. I always say, well, plan for a 14% peak to trough correction during the year. Because why? Because that's the average year has one. Most years see a double-digit peak to trough correction. So plan for that at the start of the yeyear. That way, when it happens, like in late March, when we hit it intraday, you're not ready to freak out, because it's like, well, I kind of was planning on something like this. But then you can also say, if the market goes down 10%, I'm going to rebalance. I'm going to do it. Or go to your financial advisor and say, hey, if the market goes down 10%, do the rebalance. Do this thing. Make me buy the stuff that's getting crushed, like tech over here versus buying Staples way up here, like so many people did back in February and March. And how are their portfolios and how they feeling now? They feel pretty stupid, and their portfolios underperformed a lot of alpha because of that unfortunate decision made 3-4 months ago.
Bobby, you want to take the last question from you?
Yeah, and it was just in my head.
That's a problem, Ryan, when you get past 60, which Bobby pretends he's not. But when is your birthday? It's coming up real soon, isn't it?
Mine?
Yeah.
I'll be 60 September 15th.
Okay.
I know I look great. Let's just get past it. Get past it. Okay.
Yeah.
When you guys, so somebody came up to me the other day. Jim and I were speaking at the same conference. We were on a panel together down here in West Palm.
That's legal? They let you guys on the same conference?
How about that? Isn't that amazing?
We slipped.
It was a loophole.
Was it like a bar or something?
It was unpermitted is what it was. It was unpermitted. Okay. Let's not talk about it. It was uninsured. We just did it under the radar.
There you go.
No. So somebody came up to me and said, this guy's name was Kyle. He was shocked that we remembered his name, but we don't remember most people's names, but he had a name tag on. He came up to me and he said, so, moves have been crazy lately, but I guess for you guys, it's just typical. It's not crazy. I thought to him, I remember being on the trading floor, and Jimmy will vouch for this. It was loud, so it got crazy. Like a day that was down 0.5% seemed crazy, especially if it was non-farm payrolls or, a Fed decision or something like that. But now I look at these things and I'm like, yeah, I mean, the NASDAQ went down, 7-9% a little while ago. Didn't seem crazy. What type of a move would you caution people when they say, wow, crazy day? And you go, no, not really crazy. Like what type of a move is crazy?
Ooh, that's a good one. I mean, because last year in 2025, of course, the market had a good year when all was said and done. But in February and March, before the Liberation Day crash, before we were really worried, because honestly, when Liberation Day happened, most people, myself included, thought it was going to be a non-event. Then the market dropped 10% in 2 days. It caught a lot of people flat-footed. Again, myself included there. But in February and March, we had multiple 3 and I think even close to a 4% one-day decline on the S&P 500. You know why? Because of deep-seek worries. That's going to be like a Jeopardy question 10 years from now that nobody remembers. I mean, like that literally
seems like forever ago.
We're having a war. I know it's a calm down war, but we're in the middle of a war right now. We haven't even seen a 2% decline. All right, I don't know. I mean, I don't know what to make of that, other than that's what's happening. I mean, so markets are going to do their own thing. I think when you start having 2 and 3% moves, then maybe let's say that's getting a little more squirrely. But we're not seeing that. Obviously, we're just not seeing that. Now, the other one that I love to look at, and people talk about it kind of, but I was all over this. Early in the year, Thursday was down like 7 weeks in a row. Friday was down like 5. Like if you sell ahead of the weekend, I think it makes sense. You're in a bearish phase. This isn't like rocket science, but it's true. And then all of a sudden, like in late March, we started seeing Friday was higher, Thursday higher. And it's like, oh, okay, now look what's happened. So it's like kind of like, I think that makes sense because what was happening this year, Monday was the best day of the year, the first 3 months or so, because the war and the optimism on Monday, and the market would pop. And then by Thursday, Friday, you're like, okay, never mind. This war is still going on and the strait's still closed. Now we've kind of moved past that to a degree. But I think that's another one that not as many people talk about from that point of view. So yeah, I like that.
Wow, this has been great. Bobby, should I take us home?
Yeah, that's it for me, bud.
Yeah, Ryan, thank you so much. Tell the people where they can find you.
Yeah, well, thank you for that, guys. This is it an hour already? What time? I mean,
it's an hour already. Yeah,
unbelievable.
Time flies when you're having absolutely zero fun.
Yeah, no, we're fun. No, I will say this real quickly, personal. So my daughter graduates from high school this May. This is May-cember. You guys probably remember those days. It's crazy. Yeah. So if anybody out there has a kid graduating, it is nuts. All the stuff going on. So congrats to all the graduates out there.
Have a great time with it.
And the parents that make it, because it's a lot of this and a lot of that. Get ready for the party and everything. So hope everyone enjoys that. But yeah, so I'm Ryan over at the Carson Group, Ryan Detrick. You can find me on X at Ryan Detrick. Hopefully a lot of people will probably follow me there. And then Facts versus Feelings is our podcast. I do it every week with Sonu Varghese every Wednesday morning that comes out. Talk about all the cool stuff we just spoke about. So Facts versus Feelings, or follow me on social, which are the easiest places to find me. Now, I was just named a CNBC contributor. I don't know if it's because of my big ears or my good looks or whatever, but I am going to be on CNBC a little bit more, which is kind of cool. So I'm excited.
Good for you. That's awesome. So, I spent 19 years with them, and
nice.
Yeah, most of it was great.
Stop right there.
I hope that goes well.
Thank you.
Yeah. I said, stop right there, Jim.
No, we blew out at the end, but again, there's a lot of people there who I truly like.
It's called the end for a reason, right? I guess
for a reason. It came to a logical conclusion. Well, thank you so much for joining us, and thank you guys, by the way, for this show with all the live element to it and all the DMs and all the messages. Thank you guys so much. You guys are what makes it great. Please come and follow us at unfilteredinvestor.com. We're giving away 2 weeks for $1. And then you can decide if you want to continue it or not. Unfilteredinvestor.com has been a success so far, and it's because of you guys as well. This has been the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. And, of course, that's Ryan Detrick.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.